Hello again and welcome. This is Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Today is April 28th, Thursday of 2022. Markets are moving. There's a lot of headlines to discuss. Thanks for watching. Let's get right to it. The big headline for today is the GDP report, Gross Domestic Product report for the U.S. And essentially it's the first quarter report of 2022. And it's an indication of, is our economy essentially growing or contracting? And right now it looks like it's contracting. The number was supposed to be positive. That was the expectation. And we came in negative 1.4%. Now we haven't seen a negative read on the GDP going back to 2020, actually the second quarter of 2020, when we started in the pandemic world way back when. And so we had two consecutive quarters, the second and third quarter of 2020, and that was a technical recession. And we actually had a recession, and then we had a rebound ever since then. We've had positive quarters on the GDP. In fact, if you look at our board right here, going back to 2021, we've had in the sixes. We had a strong, robust, substantial growth all on our GDP reports last year, simply because we had a lot of helicopter dollars, right? Stimulus from the government. The Federal Reserve was super eased on accommodations. Well, all of that's reversing right now. And so since that has been reversing, and the consumer is now saying, hey, wait a minute, they're still strong, they're still solid in the report, but I think they're shifting. There's a shift going to go on from wants, what the consumer wants to spend money after everything or anything, to the needs. And the reason why I say that is because inflation is now square in the middle of that. And the Federal Reserve has obviously got its hands full. We've been discussing about this for quite some time on my updates over the last year or so with regards to the Federal Reserve being behind the curve, raising interest rates to slow the economy. In fact, if you go back to my Tuesday's update, I talked about recession, a potential recession. Now, a technical recession, again, is two negative quarters of GDP. We've had all positive last year. We're starting off 2022 with a negative GDP report. What does this present quarter look like? So April, May, and June. We'll get that in July, that read. That's where we are. So do we have a negative quarter? And if we do, then we are in a recession. So if the economy is in a recession, what does that say for the Federal Reserve? Well, again, on Tuesday, I talked about this. The probability of a recession rising in the United States is high. Now, markets are up right now. Obviously, tech earnings are solid. We're getting some quality reports. We have two big tech companies going to report after the bell today, and that could give us the indication. We've got a setup right now on the indices. The Dow, S&P, and NASDAQ have all sort of retested squarely right in the zone of the March lows. And so that's setting us up for, if we get positive reports by the two tech bellwethers that are going to report after the close, and a continuation of this rally that we're seeing today off of the heels of positive earnings from corporations right now. Again, this is the earnings week right now. 50% of the S&P 500 are reporting. And as I said, even a while back, this is the week, this week and next week. Next week, we're going to have the Federal Reserve. But this week is a critical week to say, hey, listen, do we have a bottom in the markets? Again, no one's to tell, and we don't really know for sure, but from a technical perspective, we're doing some good things right now underneath the hood for the indices to retest and then hopefully keep the bottom in place, so then we can sort of work our way higher. Now, if a negative read on the second quarter GDP for 2022 is in the cards right now, who knows? But if the consumer slows down and pulls back on spending, again, wants to needs, because inflation is everywhere and rampant, we believe that's going to happen. And again, also the Federal Reserve is going after housing. Housing costs because of interest rates rising, because the Fed is running off balance sheet sort of all of the holdings on their balance sheet. So they're not supporting the mortgage market anymore. Mortgage rates are spiking, so affordability is coming down, or actually it's affordability is coming down, and the price of a home because of a mortgage right now is up 25% year to date. That's going to cool the housing market. We're seeing signs of it. I'm talking to realtor friends all day long, even my wife who's realtor, Jenica. We're seeing signs of it everywhere. So we believe housing's cooling off. It's what the Federal Reserve wants. It's the last sort of stand of inflation right now. And so hopefully inflation then subsides. We get some cooling of the economy a little bit. Maybe the Fed can orchestrate a soft landing, but we're going to find out what they say next week. We expect and anticipate a 50 basis point increase in the Fed funds rate, but that's still, again, too little too late, but they have to do less talk and more work. That's what my grandfather always said, and I think that's what Federal Reserve should listen to my grandfather, the late, great Peter Schein. So that's our update for today. Thanks for watching. We'll see you again next time.